MK Surana, the CMD at HPCL, joins in on the show right now. Mr. Surana, morning. Good to have you on the show. Reports are coming in that refinery utilizations are falling once again after hitting pre-COVID levels. How are the levels right now, Mr. Surana, and what demand scenario is panning out now that unlocking's begun?
Good morning to you and all your viewers as well. The demand in the country had picked up quite sharply up to June, and it reached around 88% or so. Now, normally the Q2 of the financial year, because of the onset of the monsoon, the demand reduces generally if you see on tonnage basis. So the same effect is being seen in this July as well. So it is no different. It is slightly aided by some of the localized lockdowns in Karnataka, Maharashtra, some of the cities. So because of that, you see some lower demand on the diesel side. Petrol, more or less, it is good. It is still 84% for the normal. And so I think the trend of the demand is in line with what happens every year in the second quarter of the year as soon as the monsoon sets in. Last year, the monsoon was slightly delayed. So if you see year on year, that will also have some impact to that extent, while this time it is slightly early. Also, in the northern area, the agriculture, crops, etc., gets over in by the month of June or so. So now shifts to monsoon-based thing, and the diesel demand reduces slightly. So I don't think there is any substantial worrisome trend as such. Rather, it has been consistently improving trend as far as demand is concerned. The impact which you see is only because of the monsoon and the local lockdowns, which are a week lockdown. And I think in the next month, again, it should rebound to the same level what we have seen at the end of June. Beyond 90%, definitely it will take some time to reach to 100% as the industrial activities pick up, as the construction activities pick up. So that should happen in the third quarter of the year.
I have to ask you, Mr. Surana, about this. There is a view on the street that Indian refiners are hugely undervalued. And if indeed the government does go ahead, as the buzz we at ET now are picking up with the BPCL disinvestment, even the indirect space gets re-rated in that sense. And this is going to be a huge endorsement of sorts by global companies as well. What are your thoughts on the same?
I think I maintained this view for a long time that the oil refining and marketing companies do not get fully valued on the way our markets work. There are huge potential, huge value in terms of the asset base, in terms of the potential. And as such, Indian refining industry has done very well, and they have established themselves to the world-class level. And slowly and gradually, India has emerged as a refining hub in this part of the world, and further expansion and the new grassroots refineries to enhance it further. And as far as the skill set is concerned, also our refining engineers had established themselves world over, and I don't think you'll find any major place where the Indian refining skill set is not being used. So I think that is a good sign for the Indian refining industry, and I hope that it sustains and it does get this to valuation.
Do you see that, given that where prices have gone for fuel, it actually will ultimately have an impact on demand per se? Because, globally, suddenly there are a lot of places where India will become less competitive. You actually could also see a change when in other countries, export front, where international commodity prices have gone down, our fuel prices have not gone down. So high fuel prices, ultimately, do you think that could be a deterrent?
I don't think so, because the total demand consists of two parts. One is the essential requirements for normal transportation of the people, for agricultural, for industrial use, etc. And there the price elasticity has not been seen in the past to much extent. At all, the prices work only on the leisure driving and that too only beyond the threshold limit, only in a particular sector of the society. So overall, we are not seeing much of impact on the demand pattern depending on the prices. So I don't think so. As far as exports are concerned, it anyway happens on the international pricing. And one thing we should remember that even the domestic prices are aligned to international pricing, and the exports or import, whatever happens on the international pricing. So the local pricing, which has got a substantial portion of the taxes, has got no impact on the exports per se. So to that extent, for the exports, India doesn't become non-competitive or something, except that the local selling may make a better sense than the export in that case. But we should remember that out of the total pricing, there is a substantial component of the taxation.
How exactly would you be balancing your future capex, and would you be looking at reducing it largely because of what's happened in the quarter gone by? Because one side you have to maintain a dividend yield because you're a PSU company. On the other hand, you've got a drop in the quarter gone by largely because of almost a shutdown and lockdown in the economy. So would you be looking at cutting down your capex and conserving cash?
No, as far as HPCL is concerned, our projects are at very advanced stage. Actually, the major projects like our Vizag refinery expansion or Mumbai refinery expansion, they are at the stage where we will be trying to complete it in the next financial year, next calendar year as such. So they are substantially, we have already invested in it. So there is no need for us to really look at it over capex. Only the new projects when we take up, and every year we do take up some new projects that we may prioritize depending on the situation as it develops. But as far as all the projects which we are already on site and under construction, we don't have any thinking on that. They're all good projects with have a good, robust IRR. We have already done a substantial part of the work. All the equipment, etc., are on site, and we will be trying to complete it as early as possible. So I don't think there is any rethink on that. And even borrowing level also, we are comfortable to that extent. If you see, as of today, our debt to equity ratio is less than 1, and our long-term debt is less than around 23,000. So it will be in the range of 0.7 debt to equity ratio for long-term debt. Even short-term debt, from compared to the last year end, which was 43,000, we brought it down substantially to around 32,000 or so. Total debt means put together long-term and short-term debt. So we are comfortable on that, and we'll be continuing with our capex program.
I'm going to ask you a forward-looking question, which is that in next 12 to 18 months, let's say BPCL is privatized. We don't know. Let's say if it's privatized, you could see an entry of a private player into the oil retailing market, which up until now has been dominated by PSU retailers. How could this change the dynamics of the fuel retailing business? Because wherever we've seen that private competition or private enterprise have moved in, they've changed the dynamics of the sector. Banking, retail, NBFC. So BPCL privatization, could that change the dynamics of the fuel retail sector?
And one thing that the Indian fuel retailing started by the MNCs like ESSO, Commercial, Caltex, etc. So the start of the business in the country for fuel retailing was by the MNCs. And some of these MNCs after nationalization becomes PSUs. So the business as such was mostly aligned to the way it is done globally. And it was not vastly different in India as compared to other parts of the world. Now, over a period, even though it was dominated by PSU in the refining and marketing sector, as I mentioned earlier, have done quite well, and they have done equal at par, if not better, as compared to the world standards as far as refining is concerned.
Mr. Surana, let's talk about forward-looking trends as well. GRMs, for example. The sense in the industry is that there has been a meaningful improvement over the past few weeks. How do you see the trend shaping up eventually?
Yeah, but just before that, the question which was there half completed. So I was just trying to mention that the Indian fuel retailing was started by MNCs in the country, and subsequently, even though the companies were nationalized, it was maintained and our outlets are also of the world standards. But as the new players comes, there will be more focus on the efficiencies, more focus on the customer offerings, more focus on the cost effectiveness. So I think it will be good for the consumers, and there will be new ways of doing the business as well. Coming back to your question on GRMs, the cracks on gasoline were subdued over a period of time. It continued in $1 to $2 range because there was a surplus inventory of both diesel and petrol in the international market. The European demands are now picking up, which dominates the diesel crack, which did showed sign of improvement and it came around $6 or $5. The gasoline cracks did not improve because in US there were again the fears of second wave of pandemic. So I think in another 1 month or so, we should see some positive movement on the cracks further, and that should help in the GRMs.
Okay, great. So that's on the GRM front that we're tracking. We also understand marketing margins are quite healthy. The first quarter reading is likely to be healthy as well. I think the overall, commentary the market wants to hear, Mr. Surana, of course, you've talked about how things have already been and the trend you've witnessed so far. But as we gradually continue to come out of the lockdown, really what you anticipate going forward on whether it's the demand front, whether it's on the marketing margins front?
Demand front is concerned, as I mentioned to you, that 85 to 90% of the demand has already come. By end of June, we have touched even 91% also. Then, as I mentioned to you, because of monsoon, there may be some reduction in the diesel demand, but again, it will pick up. So the demand front, I think it has shown very smart and quick and V-shaped recovery, and we are very happy with that. And I think that should sustain, even in spite of some localized lockdown of a week or so in some of the cities. And the states are not following a complete state lockdowns anymore. It is specific part of the area. So I think the demand front we are okay, comfortable. Even the industrial goods like lubricants, bitumen, fuel oil, there is a very smart recovery in the demand. So demand part has shaped well. As far as the prices of crude are concerned, they have remained in the range of around 40, and we think that it will continue to be less than 45 because some of the shale players will start returning back because 40, they are comfortable with 40 as the break-even prices. Also, some of the crude supply situation will start easing out over a period of time. Right now, the increase in crude price is only because the demand recovery is faster than the rate at which the supply restrictions are released. So with the reasonable crude prices and with the improving cracks, with the demand recovery, we think that it should do well, and the worst is already over in this sector. That's my view on this.
Partial lockdowns which have started again, and these are partial lockdowns, they're even more dangerous than full lockdown because you don't know when the lockdown is coming, you don't know the duration, you don't know the territory. This could again rupture the demand comeback what we've seen, let's say, in early part of July and late June.
No, I don't think so, because they are localized. City or certain areas of the city, like in Mumbai, you have got certain restrictions, and New Mumbai, or there was some restriction in Pune or Ahmednagar or some part of Karnataka, in Bangalore. I think we need to we learn to live with this type of things as the situation develops, and as we reach to a level where it is comfortable not to have the lockdown. But till that time, I think some sort of local lockdowns should be anticipated. But overall, the way the demand has picked up and what we are seeing till June and what we are seeing, I think that we can comfortably be above 75% range all the time to come. And so it will be 75 to 90 range, 80 to 90, I should say. And as I mentioned, to reach 100, yes, it will take a little bit of time when other things start getting normalizing. But as I mentioned to you, the demand of the industrial product picking up, like lubricants, etc., shows that the industrial activities are also coming back.